Hi, Larry Berman here, and here's what's on my radar this week. First, I want to clear up a misconception. So some of you may have seen this hat in the background here in recent weeks because I dropped my background. I actually have my real office here. So this is a parody, Make Portfolios Great Again. It's something I've worn on BNN a couple of times, and first a few years ago as President Trump was running for election. This is what I'm about. It's not the other thing that these red hats represent. So let's be very clear on that. I'm not a fan of the former president of the United States. So with that in mind, I'm not a fan this week of Jerome Powell either. Powell's, he got masterful at talking the market up until he was renominated. And now that he's going to be renominated, or the Fed head for a couple more years, he's now able to talk hawkish, and it's really, it kind of makes me sick a little bit when you get the Wall Street elite alumni and they, anyways, I don't know. The world's pretty broken from the perspective of trying to create growth and all these narratives that these guys just, like this. And yeah, I might fall into that talking head category, but I really try to speak from what I believe in terms of markets and everything else. And so the expectation was for the Fed to be dovish, and he was very hawkish, and he left on the table the potential to do 50. Listen, you've got 7 or 8 rate hikes priced in through 2023 now. There's no chance that they can raise interest rates that much without putting the global economy into a recession and dramatically reducing the yield curve. So the key thing here is inflation. Inflation is going to limit the Fed's ability to navigate here. And he said as much when he was asked about the yield curve runoff, and he said, well, we don't control that. And yes, they do, but they don't, right? The market does have a big vote. And so what happens with the yield curve? And so if the Fed were to aggressively tighten, we're going to see that inversion. And that would force them to stop, because that yield curve inversion, he said they do look at it, would portend a significant economic slowing, if not a recession. And we all know, because we all know, that the Fed causes every single recession by having to fight inflation at the end of the cycle. Well, this inflation is like no other we've seen in decades. Is it temporary? Is it permanent? Listen, history books will write that. I think it's going to be a little more sticky. It means the Fed put has got to be a lot lower than it was historically. It's going to be harder for them to pivot if inflation how could he justify flipping if inflation pressures keep ticking up? So it's all about inflation, and we're just not going to know. Now, by the end of the second quarter, we will have some visibility on the year-over-year changes. When you look at the basket of what's in CPI and you see housing, food, transportation. For the average person, that's 70 or 80% of the nut, call it middle-class America. For those with excess savings, plenty of discretionary spending and lots of savings. But for the bottom half that generally live paycheck to paycheck, those 3 things and very little on the discretionary side. So it will matter, and jobs matter, and the labor force matters, and wage pressures. I think we're going to see inflation pull back, but it's going to stay somewhat elevated, 2 to 3 or 3 to 4 range, well through this year and into next. And that's going to limit the Fed's ability to pivot, which means we might have a deeper equity market correction, which means that earnings matter, and they matter a whole lot, and how the market responds to them. So far, so good in terms of earnings being okay and the market responding okay. All the carnage came before earnings really started in the last couple of weeks. So if the market holds and earnings are good, we should bounce here. But folks, that's a bounce to sell. That's what's on my radar this week. In terms of bull and bear pick of the week, I've been cautioning on the high value, high growth and saying, watch the poster child for this, which is the ARK ETF. And is it a quality rally, meaning good, broad-based, good companies, or is it being led by the weak earners as a speculative bounce? And so that's the part you kind of got to watch here. And I think very much so. $50 to $60 for ARK is where I get interested again in a lot of those names. Many of the individual names are starting to come into the radar again. We're not there yet. By mid-year, I expect that we're going to get there. It might be sooner than that. But that's kind of where I'm looking now, where there's some, not value developing because they don't have any earnings, but relative value. Still like international markets over US markets as a general idea in terms of overweighting and underweighting portfolios. And that's it. Have a great week, everyone. See you next week.